Let's go to the Wall Street talk, where Renita Young, our senior markets correspondent, has another bearish note on a big tech name. Renita, what's going on this week?
It's like deja vu, because we talked about the bearish note on Google, on Alphabet yesterday from UBS, and today Bernstein is talking about the same exact thing. Now, they downgraded this stock to market perform from outperform with an unchanged price target of $125 a share. That still leaves about a 6% move to the upside from where it closed yesterday. But it's the same argument. It's concern that Google moved from too slow to too fast in AI. When we saw Microsoft talk about its generative AI products, a lot of people were looking to Google immediately to talk about its own. And now that it has brought up the conversation about Bard and its other tools that it'll use, analysts are saying that, oh, maybe this has gone too fast, and they worry that its new AI search could cannibalize its ad revenue. Now, the analyst says that this stock is up 40% from its November lows, and so now it's caught up to the fundamentals of the situation. And it does look fairly valued, with a risk reward now seen as a balance right now. But Bernstein, although they remain optimistic on the digital ad spend recovery, there is more competition coming from retail media that are all trying to get a piece of this pie, especially since companies have lowered their ad spend over the past quarter or so. Now, just as I said earlier, UBS had the same concerns yesterday. They downgraded Alphabet to a neutral from a buy, but they boosted the price target to $132 a share, and now that still presents about a 12% move to the upside from where it closed yesterday, since it was a little bit lower. And year to date, Google is still up 34%, so it's still outpacing the market, but those concerns are very real.
Seems like they're real enough for some of these analysts to start going against the grain a little bit, because still generally optimistic and bullish by the average price target, but some of the cracks starting to form here in the underlying giants that have been part of the cause of this rally. All right, another one here, a much more dramatic move, but a less important stock. Still after earnings, a good one to check in on, because we've been talking about how Pfizer and Moderna still have the COVID hangover, but the pharmacies too. Walgreens again just gets slammed.
It does, and that was one of the big reasons why this company missed its earnings. It was because of weaker consumer spending and the drop-off in COVID vaccinations by a huge measure. Now, adjusted earnings came in at $1 a share. That missed by 7 cents. Revenue was $35.41 billion. That was above expectations, and you can thank the higher prices for branded drugs for that, and more prescription drugs coming in. But vaccinations were at 800,000. That was a huge drop from the year prior, when Walgreens did 4.7 million vaccinations for COVID-19. And this new healthcare segment, however, that the company has started to form, which includes both emergency room and or both normal care, regular care, health care, and emergency care, that made $2 billion versus $600 million in the year prior. And so the company also chose to cut its guidance for adjusted earnings for the full year to between $4 and $4.05. The prior outlook was between $4.45 to $4.65. And because of all of this, it's got to plug the hole that it's been draining. So to do that, the company's going to step up some of its cost-cutting measures. It'll boost its long-term profitability of the healthcare business as well. And it's also, of course, just as Pfizer, just as Moderna, and just as other pharmacies are doing, looking for other ways to try to replace some of that COVID-19 vaccine income.
All right. So they're having a tough time right now filling in that gap. So shares are punished for it. Can't say I'm surprised. They were basically a one-trick business of basic staples that got a second trick, when COVID came around, and now it's kind of back to being what we know it. What I've been surprised by is how weak CVS has been, despite the more pure healthcare play. But an important reaction here by the market to tell us where that company's at right now. Thanks, Renita. Appreciate it. Walgreens down pretty big. We'll see how Alphabet trades. Going to be more meaningful for the broad market on another bearish analyst note.